In this deep dive, we're settling a debate that has divided group chats, podcasts, and Thanksgiving dinners. Bitcoin versus stocks versus real estate. Which one actually builds wealth? It's like the personal finance version of rock, paper, scissors, except the stakes are higher and everyone's yelling. Ask one person and they'll say, only real estate builds wealth. Another will say, lol, stocks always win. Have you seen the performance of Nvidia stock, bro? And then there's the Bitcoin crowd yelling, everything else is a scam, while tweeting from a conference in El Salvador. So, which asset actually wins? Let's break this down, so you can stop arguing and actually start building. But first, be sure to subscribe now if you want to make smarter money moves. Part 1. The 3 contenders. Alright, we're comparing Bitcoin, the digital gold, stocks, the old school compounder, and real estate, the slow and steady empire. So let's set the stage. Bitcoin is a digital, decentralized asset, capped out at 21 million coins. Volatile, potentially high upside. No CEO, no company, just code, miners, and belief, often viewed as digital gold. Bitcoin's pitch is, we're scarce, borderless, inflation-proof, and the government can't touch us. It's not here to replace Visa, it's here to outlast the US dollar. Think of it as the ultimate store of value for the digital age, but be ready for wild price swings that can make your stomach drop. Stocks. Stocks represent partial ownership in real businesses, backed by cash flow, earnings, and economic growth. They are highly liquid, easy to automate, and have a proven track record over the past 100 plus years. Stocks say, we're the boring but effective option, and we've got the receipts. And if we're being honest, they really do. I mean, they've been the backbone of wealth creation for generations, offering dividends, growth, and liquidity. Real estate. They are physical, tangible assets and can be leveraged with debt. Real estate generates monthly rental income. Real estate benefits from tax advantage. They're not very liquid, but highly scalable. Real estate whispers, everyone needs a place to live, and if you play it right, they'll pay you for the next 30 years. It's slow, it's manual, but it's powerful. Plus, you can improve your property, increase its value, and have a real asset in your hands. Part 2. Performance. Which delivers the most over time? Alright, let's talk numbers, and here's the vibe. You've got stocks. Over the last 100 years, the US stock market has returned about 7 to 10% per year on average. Yes, there are ups and downs, crashes, recessions, pandemics, but over the long haul, stocks go up. $10,000 invested in the S&P 500 in 1990 would be worth over $130,000 today when adjusted for inflation. You didn't have to pick the right stock, you just had to stay in the game. That is the magic of compounding and patience. The dividend reinvestment effect is a key factor that drives long-term growth. Reinvesting dividends into more shares instead of cashing them out is essentially like turbocharging your returns, especially when those dividends are reinvested during market dips, which compound at a faster rate when the market recovers. Real estate. Now, real estate returns are more complex. You get capital appreciation averaging about 3 to 5% yearly, monthly rental income that can cover expenses or generate cash flow, leverage through mortgages that can amplify returns, tax deductions, depreciation, and 1031 exchanges that help defer taxes. Add it all up, and with good management, you're looking at roughly 6% annualized returns, but with more hands-on work. Real estate is the build a mini empire option. It takes sweat, but it scales. Also, unlike stocks or Bitcoin, you can physically improve your property to boost value. The leverage effect in real estate is a game changer. By using borrowed capital, investors can amplify their returns on a much smaller initial investment. However, this works both ways. If a property's value declines, the impact is magnified, which means that careful market selection and due diligence are essential. And remember, real estate's performance isn't uniform. Returns can swing based on local economic cycles, regulatory changes, and even neighborhood trends. Diversifying across regions or property types can help manage the risk. Bitcoin. Now, here's where things go wild. Bitcoin's average annual return since 2011 has been over 140%. Yes, 140%. But, and this is important, that number comes with drawdowns of up to 40% regularly. And no, that's not a typo either. Bitcoin is like a financial roller coaster. It climbs hard, drops faster, and makes you question your life decisions in both directions. It is the most explosive growth vehicle, but it's not for the faint of heart. If you invested $1,000 in Bitcoin back in 2015, by 2025, it could be worth over $400,000. But you'd have to survive multiple crashes and volatile swings. Bitcoin is the ultimate asymmetric risk-to-reward asset. The potential for outsized gains is extraordinary, but the risk of total loss is very real. Because it operates in a decentralized manner, it's outside the control of any central bank, and it's resistant to government regulation. However, it's worth noting that regulatory uncertainty is one of the biggest risks facing Bitcoin's future adoption as a mainstream asset. Oh, and a quick reality check. Bitcoin's historical returns are eye-popping, but as adoption grows and the market matures, future returns may be lower, and volatility could decrease. Survivorship bias is also a factor. Most people hear about the big winners, not the many who lost money buying high and selling low. If this has been helpful so far, be sure to hit that subscribe button. We break down trending money topics just like this every week. We provide systems, not noise. Growth, not hype. Part 3. Risk, liquidity, income. Let's get practical. Okay, forget return percentages for just a second. Let's talk about how these assets behave. Risk. Stocks have a risk level of medium, assuming you invest in an index fund. They dip, sometimes crash, but they're backed by actual companies with earnings and assets. Real estate. The risk level is the lowest if managed well, but not immune to market swings, tenant issues, or unexpected repairs. Bitcoin. This is the riskiest. If you can't stomach watching your investments fluctuate wildly, maybe don't go all in on the internet money. Liquidity. Stocks are super liquid. I mean, you can sell and settle in seconds. Bitcoin is very liquid. You can trade 24/7, even at 3 a.m. in pajamas. Real estate is the opposite of liquid. Try selling a house in a weekend and let me know how that goes. It can take months, and closing costs are high. Income potential. Stocks pay dividends, but most of the return is in price appreciation. Real estate provides rental. You get paid monthly and benefit from property price appreciation. Bitcoin provides no income. You are holding for price growth, or just the vibes. If you want cash flow, real estate wins. If you want growth, Bitcoin wins. If you want both cash flow and growth, a combination of all three is kind of the best. Part 4. What the smart money does. Alright, let's be real. The wealthy don't just pick one. I mean, they're not arguing about which one is best. They're asking, how much of each should I hold, and why? Most smart investors build all three into a diversified system. They might do 60 to 70% in high-quality stocks, 20 to 30% in real estate, 10% in Bitcoin. The exact asset allocation should be based on the investor's risk appetite, age, and investment goals. Why? Because the combo of high-quality stocks, real estate, and Bitcoin grows consistently, pays monthly, protects against inflation, and gives exposure to innovation and asymmetric upside. Real estate wealth isn't built by choosing perfectly. It's built by sticking with a strategy through imperfect times. Every asset class has its pain points, but most of the pain comes from bad behavior, not the asset itself. But let's wrap this up. If you want long-term, low-maintenance growth, you might want to go with stocks. If you want monthly income and control, then you might want to lean more into real estate. If you want asymmetric upside and can stomach the volatility, then you might want to consider Bitcoin. But if you want to build real, durable wealth, own all three. Use systems and rebalance your allocation to each one constantly. And stop trying to win internet arguments with strangers. I mean, remember, this is a generalized asset allocation strategy. Do you own real estate, stocks, or Bitcoin? Or better yet, do you already own all three? Let me know down in the comment section below. That's gonna wrap it up for today's video. If you found this helpful, be sure to hit that like button, subscribe for more smart moves that actually build wealth, and share this with someone who keeps yelling Bitcoin is the future while ignoring their rent. They need a strategy, not slogans.